why playing safe in 2026 actually is more dangerous than you think. The biggest risk in 2026 is actually not buying the wrong property. It's waiting for the property market that no longer exists. Playing safe in property has also quietly become the most dangerous strategy of all. A lot of most buyers, they are waiting for prices to fall, but smart buyers are watching supply disappear. Every property cycle punishes late buyers, not the wrong buyers. If you think doing nothing is neutral, the market is about to teach you otherwise. Alright, good morning everyone. My name is Jared and welcome to watching this webinar series, the title Decoding the Property Market. The reason why I'm doing this series is because as we begin the year of 2026, there's a lot of people, a lot of clients that they come to ask me, Jared, hey, how's the property market doing? What are some of the projects you think is worth considering? Is it even safe to enter the property market? Prices are so high. Is it better for me to wait and see? Alright, so I thought of doing this webinar series to actually educate these people who probably has a lack of clarity in terms of navigating the property market. And actually the subtitle of this webinar series is why playing safe in 2026 actually is more dangerous than you think. Alright, let me give you a reality check first. The biggest risk in 2026 is actually not buying the wrong property. I bet you're surprised. It's waiting for the property market that no longer exists. Playing safe in property has also quietly become the most dangerous strategy of all. And then a lot of most buyers, they are waiting for prices to fall. But smart buyers are watching supply disappear. Every property cycle punishes late buyers, not the wrong buyers. If you think doing nothing is neutral, the market is about to teach you otherwise. A lot of buyers unknowingly make mistakes that cost them millions. Guess what? The most expensive action today that you can do in the property market is inaction. The worst time to buy property is when interest rates feel comfortable again. Falling interest rates don't make homes cheaper. They only make competition more aggressive. Rates move first, price move later. Most people actually, they react in reverse. So in the property market, you don't win in property by predicting the bottom. You win only by entering before the confidence returns. Here's the market truth. Cooling measures don't crash prices. They trap supply. And most savvy investors, they know that. The government don't stop people from buying homes. They only stop them from buying multiple good ones. Every round of cooling measures creates a new class of winners and losers. As you see how land bids go, they tell you what developers believe, not what the headline says. And last but not least, when developers pay more for land, guess what? Someone always pays for it later. So why this webinar series matters to you so much? By the end of this session, you will be able to know, number one, what's really happening in the property market in 2026? Where do most buyers get hurt? And how strategic buyers position themselves before the crowd even wakes up. As usual, when I go through my webinar series, I always do it in a very structured format. I begin my webinar series talking about the trends that most of the audience out there are probably more interested in, and then followed by the risk. Today, of course, as you enter the property market, you're considering an entry, you might be concerned about some of the potential headwinds, some of the risks that you should be aware about. And last but not least, of course, leaving you with some takeaways, what are the opportunities you can consider as well. Whether you are a first-time home buyer, you are a home upgrader, or you are an investor, there will be opportunities for you to also take something away from this webinar series. As we begin with the trends, here are the top 4 key trends you should probably get in tune with, starting with the most favorite question I get asked all the time. At the point of recording is in January right now, and we are 1 month away from Chinese New Year, I always get asked this question, hey Jared, hey, hi, nice to meet you. How's the market doing? A lot of realtors, they fear when they ask this question because they don't know how to answer. All right? So how I always like to maybe just bring your attention to this piece of article. Have you seen the latest article that US Central Bank is printing money again? All right? So if you see this article from Barron's, the headline titled, "The Fed is actually buying billions in treasury bills Just don't call it quantitative easing. Okay, so if you can see the plot here, this is a dot plot of how interest rates are expected to kind of like forecasted from September and December in between. You can see the trend that's trending down. All right, and then of course articles from Financial Times suggesting that Fed is to launch 40 billion of debt buying scheme after the money market strains, and also the Fed to resume a lot of net asset purchases, a lot of bond buying in the market. What is the Fed buying and what are bonds? Okay, what happens is that this actually injects a lot of cash directly into the banking system. All right, what actually changes when the Fed buys bonds? There will be more cash that will sit inside the financial system. All right, and this chart actually brings your attention to the amount of money supply in the US. In the US, you can see that in this chart here, since 2020, there's a very big spike in terms of the amount of money supply in the United States. And of course, the chart on the right is the money supply in Singapore. You realize that there's a very high correlation factor between the two countries. And then of course, in terms of the money supply in Singapore, naturally after post-COVID, there is also a significant increase in the amount of money supply in the system. So what happens when money supply increases? It will slip into the market for a few years. So what happens is that banks are naturally flooded with a lot of cash. With all this cash, they are more willing to lend. What happens is that loans then become cheaper. When loans become cheaper, what do you expect? To mortgage rates, they fall. And then business loans, they get cheaper. Naturally, asset prices go higher. Because this SGD is tied so heavily to the USD movements, our banking system is globally integrated. So whenever the US cut rates or whenever they print money, SG mortgage rates will follow suit. So what happens is that when borrowing is cheaper, cash naturally becomes more unattractive, right? A lot of investors, they are looking for other opportunities to put their money. So money then flows into other instruments, for example, stocks, bonds, crypto, and of course, property, right? So this is what we call asset inflation, okay? Not your everyday inflation like your price of eggs or price of coffee that goes up 10 cents, 20 cents. This is what we're talking about is asset inflation. We're talking about condo doubling in prices. These are called asset inflation, all right? So if I can just bring your attention to this table here, this is the freehold terrace house median prices transacted between 2020 to 2025 in Singapore across various districts. So if you are a person living in District 15, you realize that terraces used to actually cost sub 3 million and then gradually goes up 3.5. And then in today's context in 2025, 2026, it has risen about 4.5 to 5 mil. So this is what we call asset inflation. And across all kinds of property types in the Singapore property market, they talk about semi-D, it also shows the same kind of trend, starting from about 5 in 2020 to today, trending about 7 mil for semi-D in District 15. One-bedroom condos showing the same kind of trend. 4-bedroom condos, say for example in District 10, Bukit Timah, if you are kind of like a home upgrader, planning to put your kids into the schools along Bukit Timah, you can expect that prices are no longer what they was in 2020, let's say about 4.5 mil. Today, if you want to buy a 4-bedroom in Bukit Timah, you expected to should have about 5 mil in the 5 mil range, yeah? So what this means is that asset inflation not only hits the private property market. This chart shows you how HDB prices have also risen. This is an example of Pasir Ris HDB cluster. You can see that growth for resale HDBs are generally a little bit soft pre-COVID, but after COVID, when there's a lot of quantitative easing, there's a lot of liquidity in the market, and then naturally inflation as well as money supply increases, what happens is that generally prices of assets have also naturally gone up. And one of the very, very key questions here we ask ourselves is that if we ask ourselves, this HDB here has not increased in terms of real tangible value, right? If you look at the building, it has gone older, it has deteriorated, In terms of maintenance, probably you need more to maintain the asset. So the asset actually physically didn't increase in value, but this is what we call asset inflation. The value of what it used to cost the same thing, or probably a little bit more wear and tear already, actually in turn has gone higher. So this is what we call the phenomenon of asset inflation. Okay, with that, with so much liquidity in the market, and of course Singaporeans are also very savvy. They are looking for alternatives besides the banks, the fixed deposits, to put all this liquidity into instruments that can give them better returns than what banks can give, right? So you can see the articles last year in October, November, wealthy Singaporeans leading home purchases of $5 million and above. So predominantly, this preconception of only foreigners buying high quantum purchases, these are now actually led by Singaporeans making these high quantum purchases. All right, wealthy Singaporeans are driving luxury sales above 5 mil in prime districts, replacing the foreign buyers due to higher stamp duty. So in today's market, foreigners are no longer active in terms of the buying properties anymore, because for them to enter the private residential market, they need to pay 60% ABSD. Why property actually benefits the most in a quantitative easing environment? So first thing first is that because when you buy a property, it's bought with leverage. When interest rates drop, monthly installments, they follow suit. So what that means is that buyers, they can afford higher prices now, and this naturally push prices up. Number two, for property is limited generally in supply, so you cannot print land. You can print money, you cannot print land, especially in Singapore. So with the more amount of money, but the same amount of land, naturally, there's only one way that prices can go, which is up. And finally, because property absorbs excess liquidity slowly, but permanently. So if you compare property to stocks can crash fast, but property moves much slower. So these liquidity cycles that I mentioned, they leave a lasting footprint on property prices. So the next part is that actually, have you seen the latest article that 20% of new launches are actually bought by property agents? Because being a property agent, we are on the ground, we understand the buying sentiment, the buying signal, the people that are talking, we understand the kind of like the consensus on the ground. And generally, property agents are the first to kind of like get heads up on some of the good deals in the market. So therefore, also driving some of the demand in the market. 20% of new condos in 2025 were actually driven by property agent buying. Have you seen the latest article that more and more young buyers are going into private properties? It's actually also very surprising. More first-time buyers are going straight into new condos rather than the traditional route of going to the HDBs. If you can see this chart, which really shows the new launch purchases demographics since 1995 all the way to today, you realize that a very big chunk of the first-time buyers, they are actually entering into the new launch market already. Do they know something that most of you don't? Let's see. And then of course, the proportion of new private home buyers by age, breaking down into the age profile, you can see that over here, there's a very big spike in terms of the buyers aged between 26 to 35, forming a big part of new home condo buyers. All right? And while you worry about the market, new buyers are also entering as well. So 32,000 PRs are granted annually. 22,000 naturalized citizens are also granted annually. So while you are still waiting and see, actually there's a huge pool of people that are also entering the market, which is causing kind of like this spike in the property market buying. And also one of the key segment here is that landed homes. They're also drawing a lot of demand from upgraders, all right? As landed property supply remains largely flat at about 73,000 in Singapore, they are actually drawing a lot of demand from upgraders because of they understand the concept of asset inflation, and they understand the concept of land scarcity, which drives landed asset class as a trophy asset class for an aspiration of the new home buyers in Singapore. Finally, have you been keeping track of all the latest developer land bids? All right. You might not be aware, but land bids, land costs have actually been increasing very, very steadily. Let me give you an example. So in this slide, I've actually shown an example in the east, which is in Tanah Merah. Gotten a lot of interest recently. In 2025, the developer, which is All Green Properties, actually they bidded a plot of land just beside Tanah Merah MRT, and just bring your attention to how much this land was bidded for, all right? It was at 1,330 per square foot per plot ratio, and not just one developer bidded for it, a total of 10 bids bidded for a hotly contested bid of this Tanah Merah plot of land. In contrary, in 2020, a similar plot just beside, which is today what we know as Senegal Residence, similarly, there was also very hotly contested because this area is quite popular. There's a total of 15 developers that bidded for this land, but just bring your attention to how much this land was actually bidded for. So there's only $930. So what that means is that over 5 years, the same plot of land in the same area has actually risen by 43%, and that's a phenomenal increase. So if you are wondering why property prices are so high today, actually fundamentally the home prices that you're seeing right now is heavily driven by the cost of land that was actually bidded for. All right, and this is an example in the east, in the outskirts area. We see similar phenomenon in all parts of Singapore as well. So this is another example in Chuan Park. All right, I'm using a 2025 Chuan Park example, which is recently just awarded, Chuan Grove recently awarded to Sing Holdings and Sunway Developments, versus the en bloc project, which is now known as Chuan Park in 2022. There is a very significant difference in terms of the land cost. Okay, if you compare these two developments side by side, these two land bids side by side, what you're seeing is that there's a 30% increase in terms of land costs in just 3 years. An example in the west, so Lakeside and Sora, showing a very similar kind of phenomenon, 18% increase in 3 years. Bring you back to Bayshore, which is in the far east. If I just show you the land cost that was just bidded by Singhai in March 2025, the land cost was about 1,388 PSF per plot ratio. For the same land cost, it used to be able to get you a prime District 15 for Dunman Road, which is of course now what we know as Grand Dunman. The land cost for Grand Dunman was actually 1,350. So it's the same cost, but with the same value, you no longer can get District 15. You actually end up for the same value buying further and further, so which is what Bayshore is worth now. So this is what's happening in the market. So again, a lot of phenomena that's happening also in all parts of Singapore. This is an example in the west, Clementi. We see a very significant difference for Clement Canopy that was actually launched in 2015. And then, of course, fast forward today, we have Alta. There's a very, very significant difference in how much the land cost is for Clementi. And last but not least, the icing on the cake is what I call the EC safety factor. Okay, because the last few examples, we talk about private land, but then predominantly the main support of housing prices actually is supported by the government, which is again what we call the executive condo land cost. So if we use the executive condo, or what we know as EC land cost, as a signal of how land costs are moving, okay? So I just bring your attention to the Tampines area where we have a cluster of ECs, all right? You might know maybe a couple of years ago you had Tenet, okay, and then maybe just last year there was Orel, and then finally this year we have Revel. I can just bring your attention to the land cost as well, gradually going up from 600 plus to 700 plus and now to 768. So that's a very, very slow but steady increase in terms of land costs, which is also a very kind of like a sure kind of assurance that that's where property prices are headed towards. Okay, so this is 2025 land bids in the EC, in Sandra, as well as Revel. And also we see the same phenomenon for Woodlands EC as well. So far we've talked about land bids, we've talked about the money markets, we've talked about inflation and quantitative easing. Ultimately, end of the day, housing, its house price movements are also backed by supply and demand. So one would ask, where is the demand coming from? All right. So if you refer to the latest report by DBS, a huge part of course, the demand for housing is really backed by Singapore's population growth. So in the DBS latest report, 2020, government is really focusing on few key things. All right, that's a lot of emphasis on rejuvenating the city center, which is what we see right now in Orchard as well as Marina area. We also see a few trends that is important for you to take note. All right, the amount of HDB units are expected to go up by about 200,000. Condos will be expected to go up by about 120,000 in the next 15 years. But surprisingly, for landed supply, they will actually be remaining flat. If I can just bring your attention to this chart, all right, you can see that this slow but steady increase in terms of supply to accommodate to Singapore's population growth, the biggest chunk of the kind of like the Singapore housing will belong to naturally the HDB, which is the red bar, all right? And then the pink color one will be the private housing, all right? So it's about 120,000 increase in terms of condo units. But really the interesting thing is that landed supply continues to remain flat, right? So naturally, of course, there will only be one way where landed prices will be headed lah. This is a graph that shows the correlation between house prices and of course our income levels, and they move gradually in tandem. So this is actually a very healthy signal that our home prices are supported by people who can actually afford, because income levels are rising in tandem with the property prices. So there's a very strong fundamental to make sure that affordability is kept in check. Forecasts like this happens when population growth is on track, okay? If you are aware today that we have the white paper that the government is planning our population target, 6.5 million or 6.9 million by 2030, and we are very, very much well on track. We are approximately about 6.1, and we are definitely on track to hit 6.5, which explains the supply, as I mentioned to you earlier, where condos are expected to increase by 120K, HDB are expected to increase by 200K. All these are the supply that's needed to keep up in tandem with the population target of Singapore. So, and last but not least, a lot of the clients, they ask me, so where do you think prices are headed? Okay, given that we are so high right now, it feels very scary, to be honest, entering at a high. But I always like to tell my clients that it is normal to feel this way, because prices will always feel the highest at that point of time, all right, when you enter. But on hindsight, you always wish that you had entered yesterday, all right? And let me tell you why real estate is like that, because it's a cycle and it's actually very, very predictable. First of all, you must understand why property always feels expensive after each cycle. Again, if you just rewind back to all the slides that I talked about quantitative easing, basically it begins by the US printing money. When US prints a lot of money, there's a lot of money supply entering into the banking system. What that results in that is interest rates, they fall globally. All right, there's a lot of cheap money that flows into assets, as we understood already. What that means is that a lot of buyers, they are flocking into the property market, so prices naturally go upward. But it's a cycle, right? When interest rates fall, they also have to go up as well. So that's what we call quantitative tightening. So when QE stops, when rate rises, what happens to property? Property prices, they stop rising. But the prices do not return to the old levels. So in fact, with each cycle, right, it resets to a new price benchmark. It resets to a new price wave, which is always higher than the last. So there's a saying, the next high will always be higher than the last high, but the next low will always be higher than the previous low. So what happens when QE reverses, which is what we call quantitative tightening? When money is being sucked out of the financial system, naturally rates go up, asset growth then slows down. But in Singapore, because population keeps growing, as I showed you earlier, land stays scarce and supply is very controlled. So instead of the market crashing, prices actually flatten. The transactions we do slow down, but entry prices, they will stay elevated. Okay, so this is why Singapore rarely sees a deep property crash. And this is a very, very important slide. Okay, this is a slide of how the 5-year cycle pushing new launch PSF up about $400 every 5 years. So if I just rewind back to 5 years ago, if you can see the outskirts, they were doing about 1,002 to 1,006 PSF. For City Fringe RCR, they were doing about 1,006 to 2,000 PSF, and Core Central Region, they were doing about 2,000 to 2,005 PSF. But every 5 years, there will be a new price benchmark that's being created. So if fast forward to today, you can never go back to last time's prices anymore. All right, so today outskirts are minimally doing about 2,000 to 2,002 PSF. For city fringe, touching about 2,008 to 3,000 already. And for the core central region, it's all minimally 3,000 and up. Real estate is a cycle. As you can see here, these blue bars demonstrate what we call the completed supply in the market. Okay, so for developers, they are actually very, very proactive. When the amount of units in the market remains available, what that means is that developers' land bank becomes empty. And then what that means is that they become more aggressive when they start to bid for more land to fill up their land inventory. So when that happens, developers, they will launch aggressively. New launch will become very high in supply. When supply becomes very, very high, developers focus on land acquisition. And then new launch supply becomes low. And then the reverse comes again. So it's a cycle, it keeps happening. But with each cycle, which every cycle is about 5 years, new price benchmarks are being formed again. All right, so now we are slowly shifting back into a seller's market when interest rates are low, when there's a lot of positive news in the market. They generally know that for sellers, they are able to hold on to their units longer. They know that there's a lot of buyers in the market taking advantage of the low interest rates. Everybody wants to enter into the market. So there are generally now more buyers than sellers. So that's a seller's market. So that's where prices will expected to be on a very bullish kind of movement here. So I hope you enjoyed all these past few trends. As I mentioned, I forgot to introduce myself. My name is Jared, your consultant. All right. Over the years, I've had the privilege of helping families, investors, and homeowners navigate Singapore's real estate market with clarity and confidence. I use my signature 3P framework to help my homeowners, guide them with clarity with a very structured framework to plan a very solid exit strategy for them to have a bulletproof property portfolio. As we move on to the next segment, we talk a little bit about risk. All right, as a homeowner today, you will be surprised by actually the illusion of safety. A lot of people also, they go into the property market without a proper exit strategy. A lot of people are also worried about overpaying for the property. Believe it or not, one of the talks in the market right now this year, there may be some sentiments that cooling measures might come in as well, and it may be something of your concern as well. The first risk I'd like to bring your attention to is the illusion of safety. Today, you have probably two options. You can either do something or do nothing. Cash always feels safe, but it erodes your position. Waiting creates opportunity costs, and missed cycles are rarely recoverable. Standing still in a rising cost environment is moving backwards. So if I bring your attention to where property prices were 5 years ago in 2020, 2021, you are a first-time buyer, you are starting a family, you want a 3-bedroom in the outskirts area, you could probably buy something in the 1 mil range, but today that's probably impossible already. You minimally need about 1.5 million to buy something in the 3-bed segment in the outskirts area. And of course, fast forward to 2029, we see the similar trend that you probably be in a 2 mil range. So staying put, not moving, sometimes may actually be more dangerous than making a move. All right, and I just bring your attention to everybody in their life have different seasons. All right, whether you are first-time buyer just out of school, or you're a high-working professional making good income in your 35s, or maybe you're a high-performing executive in a company, maybe even planning a semi-retirement life. So in every stages in our life, we like to say what we call season. And I want to bring your attention to the strongest seasons. If you are in this summer or autumn season in your life right now, these are probably your very strongest seasons, and you should be very deliberate in terms of making plans in your property portfolio. Let me bring you to this concept called the equity triangle. Okay, this equity triangle is kind of like an illustration where you are able to kind of like visualize your asset property portfolio starting from various stages of your life. The goal here is to increase your asset value over time, to increase the amount of equity over time. So the concept here is that when you reach the age of 65, the total amount of equity will be the amount of money or the asset value that you'll be able to retire on. And the idea here is that at 65, you should have zero liabilities, so all your mortgage should be fully paid, and the amount of asset that you're sitting on would be the amount of money that you can kind of diversify and use as your retirement fund. So a lot of people in their summer or autumn seasons, they fall into these categories here where they should be aware and intentional about asset planning to guide them into the correct kind of asset portfolio they want to be in their later years. So this is an example of a client that I've served, started from selling the HDB and then of course intentionally upgrading into a private property, and then moving on to multiplying the asset portfolio, husband own one, wife own one, and finally consolidating their assets into a total portfolio of about 6.2 million. So in terms of the asset triangle versus should they have not done anything and stay put, right? Their HDB, which was worth about 600,000 in 2021, is currently worth about 800K. The last check is about 800,000. So although there is a 3 years appreciation of 145K, if they didn't take action, their asset portfolio to today, right, will be a very, very stark difference. Versus with intentional planning on their portfolio expansion, okay, as they slowly grown their HDB from 660K in 2021 to 6.2 million in 2025. So this is what we call in your summer seasons with intentional planning of your portfolio expansion, with a strategic maneuver of how you own your property portfolio, you're able to end off at a more strategic place in your asset equity triangle. So this couple that I'm serving is also planning their landed move next because they have a goal in mind to reach this certain asset value when they're 65, all right? And then what that means is that when you are younger, there's a lot of the income that you generate is in your active years, all right? This is, of course, also naturally the most risky because there's also the risk of being unemployed, you fall sick, you're not able to kind of generate this active income anymore. But so all the active income, if you are in your summer or autumn seasons, you should deliberately, intentionally drive wealth into the asset income and then finally driving passive income in your later years. This risk, as we know, is no secret. If today you are in the tech industry or you're in a high-risk industry, layoffs are generally quite common these days. Loss of active income is something that most young professionals, they worry about. So when in your later years, in your winter season, you probably have no more active income anymore, and then you have to rely on asset income and passive income, which kind of like give you some of your passive income for you to live comfortably. And should the couple actually didn't make intentional planning in terms of property portfolio, staying put, and of course with the HDB is worth about 800K, if let's say they were to cash out and say downgrade to a smaller HDB, what they will end up with is only 300K, which is obviously not very ideal and not enough for retirement. Versus if they have strategically actually grow their assets to be intentional about growing the asset to about 10 over mil, potentially this could be a scenario here with a diversification plan where you can actually diversify that 10 mil into maybe buying a condo for own stay, all right, and of course having a second property for some passive income, and then keeping some liquid cash in terms of emergency, and maybe also potentially buying some dividend stocks such as DBS that gives you 5% per annum. So this is what we call retirement planning with very intentional property portfolio planning in your early summer and autumn years. This of course in your kind of like your autumn season to winter season at 55. If you are sitting currently on an equity of 7 mil, this is what potentially you could do as well. You could own a place for staying and then of course diversify the other equity into other instruments to generate you quite a healthy kind of a passive income and liquid cash for rainy days as well. Okay, so that's generally in terms of seasons, you have to be aware, should you today decide not to do anything at all, what is the outlook going to be for you when you reach retirement? Do you have enough equity to retire on? Another example, another concept I'd like to bring your attention to is of course this TLC concept, which is tenure, leverage and capability. And we know that as we age, generally what happens is that loan tenure reduces. Giving you an example on the left is that a 35 years old example of someone who makes about 15 to 25K per month, okay, versus another scenario here if you are 10 years older and making the same levels of income. Generally, because of TLC concept, there's a very significant reduction in your leverage amount, okay? Approximately about 350K in terms of healthy leverage. Let's say if you don't own a car, okay, versus if you have a car loan of about 1,000 a month, you'll see a very significant leverage amount that will impact you directly if you compare when you're 35 or 45. And this leverage amount reduction is approximately $500,000. So what that means is that if your ability to borrow drops significantly, you will also find yourselves being priced out of the potential buying opportunity as well. And then that will significantly leave you in a position of being priced out and harder and harder to reach your retirement goals. Okay? So the key point here is that take action when your TLC is strongest, especially in the summer, spring, autumn seasons. The next risk, buying without an exit strategy. So good properties can still be bad investments if your entry without exit is as good as trapping your equity. Liquidity actually matters a lot more than height. If you don't know how you exit, the market will decide for you, okay? And you don't want that to happen for you. As Warren Buffett said, rule number one when you buy property or buy anything in the market is never to lose money. Your rule number two, never forget rule number one. And this is the most quoted investor on the planet Earth, right? Warren Buffett, I love him a lot. You'll be surprised, this concept here, I tell you guys, avoid property stagnation analysis. In Singapore, got people lose money or not? All right. This is one of the client that consulted me. All right. He bought a property in 2008. All right. Held for 15 years, zero appreciation. Price at 2023. Sorry, apologies for the dollar sign. Basically, for 15 years, zero appreciation. So this is as good as losing money because in the last 15 years, inflation crept in. The cost of basically everything around you has gone up. Your property value has remained stagnant. So actually, instead, it's kind of like quite bad in terms of scenario here. Okay, some of the examples here, you can see some of the properties that I've seen. All right, of course, I don't want to mention the property condo names. They are also losing money, even though they are freehold and they are generally newer in 2023. Okay, so not all properties make money. Please be aware about that. If you cannot invest in a property that appreciates in value, right, guess what? It's better off buying treasury bills. So it's extremely important to go into a zone with uptrend track record. And you should be minimally, when you're entering the property market, be hedging against inflation. All right, so one of the examples is Sterling Residence. You can see that since launch in 2019 and all the way to 2025, there's a very, very good kind of uptrend potential. Queens Peak, Margaret View. So generally, all these condos in District 3 are showing similar kind of performance potential. But you will say, everybody say, but in the last 5 years, there's COVID recovery, so all properties, they enjoy uptrend. I'm sure you probably are one of them as well. But in these 5 years, there are also properties that lost money, okay? So an example of Scott Square, right? Dual residence remain pretty flat in Jervois area. These things happen, so you cannot just blindly assume that all properties made money. All right, overpaying for the wrong type of certainty as well. There's some brand name without fundamentals, new launch hype without PSF logic, and then of course resale bargains without transformation catalysts. Certainty in the wrong place is more dangerous than uncertainty in the right one. Okay, and let me just quickly show you how does overpaying for hype actually look like. So I don't know if you are aware about this, but then of course this is the M. I can't remember which year is this, I think in about 2021, 2020, where Wing Tai actually sold 70% of the M over the launch weekend. So 70% is definitely a very good performance for a developer. But let me just show you what nobody tells you. Let's take a look at the sales performance chart for the M, generally since launch in 2020, all right, up to today in 26, that is very, very slow in terms of price growth here. And you see that in terms of the annualized transactions or people who have offloaded, they are making an annualized of about 0.4 to like 0.6. And let me just ask you a question, how much do you think inflation is right now? All right, assuming inflation is now hovering in a range of about 3 to 5%, having an annualized kind of growth of 0.1 is as good as losing money. All right, so I don't know, this is obviously looking like someone who has overpaid for hype. Definitely not something that you want to be in the same scenario as. Another example, more than 201 Pearl Bank units launched for sale snapped up. So this is considered a very good performance because some of the first-time buyers who were previous owners of this condo, they had first dips of this condo. So a lot of people can see the show flat was very, very crowded, good sales performance. But fast forward to today, look at the sales performance here since launch day in 2019 that remain very, very flat. And it's quite disheartening to also see a lot of people who bought into one Pearl Bank actually lost money or made unprofitable transactions. So what happened to this COVID effect, right? So you cannot assume that because of COVID, everybody made money, because unfortunately there's some poor people that chose the wrong property because of hype or because they were chasing the next new thing, and then they ended up in quite a very unpleasant scenario. And the thing about property market is that you take a lot of time and maybe a few years to reverse a bad decision. It's not like stock market, you can just take the loss and then just buy into something else and then just recover back. For a property, you lose a lot of time, and generally it's a lot of effort and time that is needed to recover, or probably you never recovered at all. Number 4, so as we talked about so much about the launch performance last year, all right, how property agents are driving the market demand, naturally there is also some sentiment that I'm worried naturally that cooling measures will come in this year, and those without structure, those without a proper plan will be hit the hardest, because strategic buyers, they adapt, but emotional buyers, they freeze. So policy like cooling measures, they don't kill opportunity. Please don't misunderstand. What they do is it filters the participants. Okay, I am generally worried about new cooling measures in 2026. All right, I wouldn't be surprised if the government intervene. Such news like that on the market may not be a good thing. With such headlines saying hot sales of new launch condos can be too much of a good thing for developers, it's a sign, it's a signal. It's trying to keep you kind of like, all right, I don't want to shock you suddenly by giving you a new policy. I want to just preempt you a little bit first by giving you a teaser of what's to come. With such news like Sky Holland, which draws 8,000 over visitors, I can't remember how many checks, but it was three times oversubscribed. And of course, Penreath was about 3 to 4 times oversubscribed. So naturally, in the market right now, there is a lot of demand, a lot of greed. I would say the greed sentiment, greed index is on the higher side. What we could probably expect is with the government coming in to try to cool things down a little bit. But then please don't understand, all right? Cooling measures, again, it's not here to crash the market. In fact, cooling measures is not something that's new to us, all right? In the last few years or maybe even decades, there has been instances of cooling measures in many forms, in many policy measures, such as the ABSD, as the TDSR, and of course the cooling period, all right? But what naturally happens is that it filters out a lot of the participants. The market always adapts, and the market always goes into another high, all right? So it's important to understand today, potentially if a cooling measure comes in the form of loan tightening, or it comes in the form of, say, additional down payment needed or extra stamp duties. Are you a borderline case today, and will you be priced out? All right, because that will be kind of like a signal, some sense of urgency for you to kind of enter into the market before such policy shocks you down the road. Cooling measures versus property indexes. So naturally, again, property prices will still come higher, all right, despite many rounds of cooling measures in the last few years. It has shown that as more and more transactions are filled by Singapore buyers, prices will continue to grow steadily, because cooling measures has done its job for steady growth rather than speculation. So it's in the government's intention not to crash the market, but to always make sure that the property market is in a steady growth, that it remains accessible and affordable for majority of the buyers in Singapore. Okay, so that's the risk that we talked about in this presentation. We will be moving to the last part, which of course is the more exciting part about opportunities. We'll talk about what to buy in terms of inventory selection logic. With so many options in the market today, especially 2026, is there a framework that we can use to identify some of the best buys versus the other products in the market? The second thing, is there a framework to determine how to buy? Is there a strategic execution that we can deploy? All right, and of course, portfolio thinking, because buying a property, right, is not just you cannot have a single purchase thinking. I'll elaborate a little bit more later. And finally, of course, understanding the power of leveraging. Let's go. All right, so number one is about what to buy inventory selection logic. So for new launch, for future pricing power and leverage efficiency, resale for immediate value gaps and transformation plays, and of course, balance sheet for matters more than property type. The right kind of inventory depends on your role in the market, not your emotions. Let me elaborate a little bit more. In 2025, there will be a lot of attention that's siphoned into the new launches, and it's important for you to be clear of what the noise is, and of course to stay ahead of the game. All right. So news like that, a lot of attention on new launches. Zion Grand last year in September, I think there was about 5,000 units that moved last year. All right. In 2026, there's a lot of launch pipeline in the market. If you would like access to all these materials, please feel free to just drop a comment or leave me a DM. I'll come back to you on these materials. So, and of course, in Q1 or first half of this year alone, there's already a lot of excitement on the ground, some of the exciting launch pipeline that you can potentially look forward to. But what happens for these new projects that are actually leveraging on the, sorry, not leveraging, but all these new projects are actually based on the new land costs. And then of course, these new benchmarks for 2026 is something that you probably need to get used to, okay? So for outskirts, you probably need to be already very used to say 2005 PSF. So a 3-bedroom, about a 900 square feet house would cost you maybe about 2.25 mil because of GFA harmonization. For city fringe housing, we'll be expecting to be about 3,000 PSF. And for the core central region, naturally, you will be expecting about 3,500 PSF. Okay, so these are the new launch benchmarks that for 2026, you would definitely need to get used to. These are the 3 types of inventory depending on what season of life you are in and what kind of inventory that is more catered to your needs of your life at different stages of your life. There are generally 3 different categories of inventory in the market, which is the resale, which is based on immediate needs and wants you need to move in immediately. And of course, in the new launch market, there's 2 types of inventory. One we like to call the balance inventory or the balance launches. These balance launches are actually hidden mines that are constantly overlooked because these are based on old land costs, say in 2023 or in 2024, versus the new kind of new launches, which are new benchmark based on new land costs. So depending on what kind of buyer you are, what are your needs and objectives, you would naturally pick a framework and a selection kind of logic to determine what's the best for you. A lot of people ask me, Jared, but for balanced inventory, does it mean that we are buying units that nobody wants to buy? Are we buying leftover units that the developer cannot sell? And what is our future runway? Do we still have capital appreciation potential if we buy something in this segment here? So I'm about to just really help you to shed some light on this part. I'll just bring your attention to this back in 2021, where a scenario where a buyer was considering a unit at Affinity. Right, in 2021, Affinity was actually launched in about 2018, 2019 after the cooling measures. So in 2021, there was still quite a lot of units available, but buyers were naturally afraid because they were worried that they were buying into something that probably not so good. Why is it still available after 3 years? All right, but actually in the same year, in 2021, there was a new news about AMO Residence, which is a land plot at Ang Mo Kio Avenue 1 that hit the headlines that was actually bidded for a land cost of about 1,001, close to 1,002. What this piece of news actually created is that there was a new launch price that helped to catalyze the price movement of the balance inventory. And naturally, you can see that the graph of Affinity at Serangoon trended upward still, despite people entering in the balance inventory phase 3 years after it was launched. Generally, buyers who entered in 2021, they still benefited from the price catalyst of new land benchmark prices, and it still went up. You can see that for the profitable transactions, people who bought during balance inventory phase, post-launch phase, they benefited from the price catalyst announcement and still made very, very healthy kind of profits. So buying balance inventory may not necessarily be a bad thing. It's always about entry price and understanding price movements from new price benchmarks being set. Another example for Park Esta, all right, in 2021, 2022, okay, naturally again, there was balance units available. Buyers were worried, were they buying something that there was unwanted or developers couldn't sell? But there was also a very, very big news about when Dunman, that plot of land along Dunman Roads was also announced in terms of land bid, and the land cost at the point of time was 1,003, significantly higher than the land cost of Park Esta, which is below 1,000. So again, this announcement of new price benchmarks being set naturally catalyzed the price of balance inventory. And you can see that similarly for Park Esta price movements, even though entering into during the post-launch balance inventory phase, naturally buyers still profited and enjoyed quite a bit of upside potential as well. So you can see Park Esta, even to today in 2026, we are talking about an average PSF of about 2,006 versus when they bought in 2022 during the post-launch balance inventory season, they entered about 2,000, 2001. So that is a major $500 to $600 PS upside even though they bought into the balance inventory phase. Take advantage of the old land costs while there's still an opportunity. Don't be confused or misunderstood that balance inventory is items that nobody wants, okay? So you have to be very clear how to identify opportunities in the market. So let me give you an example. I'd like to share this Faber residence as an example today. If you're considering a unit in the 4-bed, 5-bed segment, I'm happy to share with you Faber as an example, which the land cost currently that was bid in 2024 was $900 PSF PPR. All right, if you are familiar with where Faber is, it's actually located in a very mature estate of Clementi. It's 1 kilometer of Nanhua Primary. Okay, what do you think is the most ultimate safety net? I always like to share with my buyers. If you just reference where the Singapore price trends are, we always talk about EC, outskirts, and RCI, and we want to see what the price trends look like. Generally, the price disparity effect of EC and city fringe, disparity effect of EC and outskirts, they have a very strong disparity, about 40 to 50%. But what we're seeing today is that for EC land bid prices right now are about the $700 closing to $800 range. And then with reference to Faber land cost at $900, the disparity effect of EC and outskirts is only as low as 16%. So for EC, it forms as a base. It's your safety net, it's a support layer, all right? And then knowing that your price is well supported and very close to the base safety layer, it's actually a loss protection mechanism that gives you assurance and advantage that your property have a very much stronger upside in the time to come. All right, so opportunity to how to buy. This is about strategic execution. It's about understanding the 3P framework: price, position, plan. Price makes you comfortable, but position and plan actually makes you the money. Right? So there's two different kinds of condo selection framework I like to share with my buyers. Is that the first one is always understanding what the project DNA is. So this is more static. All right? We talk about things like volume effect, schools effect, MRT, rentability, URA transformation, exit audience tenure. These are inherent characteristics that you cannot change of a condo. But buying something with a good DNA does not guarantee upside potential. The correct framework to be using to determine upside potential is what we call the P3 framework, which we need to identify a project's price. All right, we talk about price disparity effect with reference to the resale market, price disparity effect to generally the same district, same region, and understanding how the lease reset principle plays an important role in your exit audience 4 years later. We also talk about position, we talk about stack analysis. Factors like unit facing, layout choices affect long-term value and price appreciation. We also talk about floor plan analysis in my third P plan, using very clear data-backed methods to match condo layouts to biodemographics, analyze floor plans, and enhancing resale and rental prospects. So these 3P framework is very important to determine your entry potential and your exit audience so that you are able to kind of like predict your capital appreciation in future. All right, so this is an example of a price disparity effect, understanding how your unit compares with the resale market if you are entering into the new launch scene, understanding how your lease compares to the nearby surrounding resale, to understand in 4 years later when your buyer is looking on Property Guru, understanding how wide of a lease disparity are we talking about. And of course, if you are buying into a new market, and then of course learning which stack will be able to give you a better advantage over other stacks in terms of your expectation of capital appreciation potential. So this is the third P in my 3P framework that we analyze for buyers if you are entering into the new launch market today. Last but not least, we also have a property scoring framework. If you are deciding today between project A and project B, it's important to have a very systematic kind of objecting framework, all right? Learning how to identify certain key characteristics here. So there's some matrices that we use. So from investment quantum effect, future buyer effect. So with a very weighted average and then therefore scoring on a very kind of a balanced approach to determine whether which kind of a property would be more suited to your needs as well. So this is very good. This is one of the technology apps that we have created to help our buyers to make a more informed decision of their choice when they're choosing whether is it a project A or project B. Moving on to the third, which is the portfolio design. Today, buying a property is just making a decision, but if you are buying 2 or more, it's a strategy. And capital allocation beats home hunting. The biggest winners don't just buy properties, they design portfolios. So if in this market here where we have so many options, what we always like to share with our clients and our buyers is to always hunt for properties in the high growth areas, all right? So whether you are in quadrant 1 or quadrant 2, it's important to identify properties in high growth segments rather than low growth segments naturally, of course. And sometimes properties, they come in 4 different types of classes in terms of investments. So you could be in the low price, low rental. Of course, this is definitely something to avoid. Naturally, if you are looking at low price growth but high rental, this is not so ideal also. Naturally, the best kind of investments will be a capital appreciation. Okay, if there is a strong rental yield also, that will be definitely a very big plus point here. Okay, I won't go too much into detail, all right? But naturally, analyzing different kinds of properties and what they are able to give you in terms of returns is very, very important. We have done multiple scenario simulations to give you understanding of what kind of product classes will give you the kind of returns that you want. We also talked about portfolio design. So with the concept of the equity triangle using the portfolio expansion, whether you are going to a 2-condo route as a stepping stone to your freehold landed dream, finally settling down into HDB for retirement, which is portfolio design A, or whether you are doing the 1 condo but a big floor plate kind of 4-5 bedder route and then moving into your freehold landed, or going into strategizing into space, buying a 99-year landed on a more affordable price and also owning a condo for investment. All right, so different kinds of portfolio strategy will cater to different kind of buyers. So as a buyer today entering the market, it's important to understand which portfolio design will be more strategic in terms of aligning to your needs. When switching to a stronger asset class, it's important to understand that in an uptrend market, switching to a stronger asset is a key strategy here. If you can see, let's say for a 1,200 square feet condo with currently valued at 2.5 versus say if you are moving into a landed property about 4,000 build up at 5.5. You realize that every $100 in terms of PSF difference here, it's a 120K increase on your condo, but a much more significant increase of 400,000 over on the other stronger assets. So it's important to understand the big picture, all right? When in a seller's market, in the uptrend market, moving into a stronger asset is the priority. And a lot of buyers, a lot of homeowners, they are stuck in their current property because they are unwilling to let go. And they are unable to see the bigger picture in the uptrend market, why the stronger asset is more important for them to pivot into that stronger asset class. Okay, in this example here, it could also be a 4-bed new launch, 1,005. The impact of the move is a lot more impactful versus currently in the smaller condo. So this is another example of a 900 square foot condo, which is currently worth 1.5 mil, versus the next stronger asset class, which is a 4-bed new launch at about 3.5 mil. So every $100 per square foot difference is definitely a bigger impact on the stronger asset versus rather than the smaller asset. Finally, I'm down to my final opportunity, which is the power of leveraging. This is a very important concept here to understand that there's always 3 different investors in a property investment. First is yourself, then you have the bank that's co-investing with you, and if you're renting it out, you also have your tenant that's co-investing with you. And you see, right, for yourself, everybody has different interests when you buy a property. For you, you're hunting for the profit. For the bank, they're hunting for the interest that you pay to them for the loan that you take. And of course, your tenant is up for the utility of space. That's why they pay you that monthly rent. And if you understand, like, give you an example of a 2-bedroom investor, about 1.9 mil. All right, if you look at the capital entry, all right, say for example, if you're buying a 1.9 mil and then you exit at about a 400K kind of profit in 4 years, all right, you extract a total about 945,000 in terms of capital. All right, your ROE after considering exit fees, your net gain is about 253K. That in turn results in a 65% return in 4 years, which is about 16% return per annum, which is great. But what if you want to rent out your property? There's a saying goes that landlords grow rich in their sleep. So real estate actually is the safest investment in the world. It's the only thing they are not making anymore, that landlords grow rich in their sleep. It's often quite true if you look at the example that I'm going to be sharing with you shortly. Generally, if you're a 2-bed investor, you buy the property at 1.9 mil, your initial outlay with the down payment and the stamp duty is costing you about 500 over 1,000. Your first co-investor is the bank, all right, which puts in for you about 75% of the property value, about 1.4 mil. And then if you rent out your property to the tenant pays you a rent of 5,000. Right, your monthly mortgage based on a 25-year loan tenor and a 1.5% interest rate today, your monthly installment is about 5,007, which is further then broken down into 2 components here, your principal and your interest, which is about 3,009 and 1,008 based on today's interest rate. So you realize that this important concept here, that your tenant pays you a 5,000 per month rental, your monthly installment is 5,007 broken down into your principal and your interest. Now think about your tenant as your second co-investor. So your tenant who pays you $5,000 a month is actually helping you to pay the bank interest and a portion of the principal, which is 3,002. You as a main investor just need to top up $700 here. And with that, for you, your monthly returns as a main investor, you put in $700, you get back 3,009. And what that means for you is that $700 earn an extra 3,009, which translates into a 557% of returns per month. Your principal here, you put in $700, you get back 3,009, which translates to a 557% return on your initial input here, right? So that is a great way to understand the total as a landlord today. If you're looking to rent out your unit, all right, not only your bank is one of the co-investor, your tenant is another co-investor, which is actually helping you to get you rich when you're sleeping. Without further ado, I have reached the final, the end of this webinar series. If you find today's session very meaningful and you're ready to take this forward, do not hesitate to book your one-to-one strategy consult with me. All right, please leave in the comments or DM me directly for me to reach out to you. What I'll be doing for you is I'll be customizing a strategic portfolio that's customized specifically for your situation. All right, I run, whether you are a first-time buyer in the 25 years old like John, or whether you are upgrader who have young kids like Keith and Jane, or maybe you're in a winter season or autumn season in your life as maybe looking to pivot into a lender segment class like Jack and Carol. What I do for my clients is that in this one-to-one consult, I will have a very step-by-step approach, really customized and catering kind of like a property portfolio management for you to undertake, and learning based on your needs and objectives, helping you to create very customized solution in terms of especially for your property needs. Without further ado, thank you for watching this webinar series. I hope you enjoyed and had a lot of value to take away. My name is Jared. Feel free, do not forget to click, share and subscribe. I look forward to seeing you soon.